Good morning and welcome to T-Hub Capital, the Investors Lounge, the podcast where we explore financial market dynamics, emerging trends, and the insights that shape successful investments. Each week, we'll delve into the strategies and analyses that drive our investment decisions. You'll get an insider's perspective on the factors influencing markets and the potential winners and losers of tomorrow. Subscribe to the podcast to stay ahead of the curve and make informed investment choices. Enjoy listening.
Welcome to T-Hub Capital's The Investors Lounge weekly newsletter. Today's date is the 10th of June. Let's dive into the week's top market news. ECB cuts rates for first time in 5 years. European stocks mostly rose after the European Central Bank announced its first interest rate cut in 5 years on Thursday. The Pan-European Stocks Europe 600 index climbed 1.04%, with Italy's FTSE MID gaining 0.49%, Germany's DAX adding 0.32%, and France's CAC 40 index ticking up 0.11%. The UK's FTSE 100 index bucked the trend, slipping 0.36%. The ECB lowered its deposit rate to 3.75%, in line with expectations, but remained tight-lipped on any future cuts. While the Governing Council stated that it was appropriate to moderate the degree of monetary policy restriction, ECB President Christine Lagarde emphasized that the central bank was not pre-committing to a particular rate path. Lagarde pointed to continued strong domestic price pressures and elevated wage growth, predicting that inflation would likely remain above target well into next year. The ECB also revised its inflation forecasts, predicting that inflation would average 2.5% in 2024. Up from the previous estimate of 2.3%. The estimates for 2025 and 2026 were adjusted to 2.2% and 1.9%, respectively. European economist Tomasz Wielodek highlighted the mixed picture presented by inflation data, with underlying inflation slowing in April and company profit margins beginning to absorb wage growth. He noted that the ECB's decision was driven by confidence in its inflation forecast, but emphasized the data-dependent nature of future policy decisions. Wielodek suggested the possibility of 2 additional rate cuts this year, most likely in September and December, although this could change depending on the data. Following the ECB's move, Denmark's central bank also lowered its benchmark rate by a quarter point to 3.35%. Now, our insight into alternative markets. Private debt in Italy nears €35 billion in 2023, driven by securitizations. The Italian private debt market saw transactions reach nearly €35 billion in 2023. Significantly surpassing the total value of deals in 2022, €27 billion, and exceeding the record levels of 2021, €29.6 billion. These figures, aggregated from BB's private data, reveal a dynamic market landscape driven by various factors. A key driver of the market's growth in 2023 was the surge in securitizations, which played a pivotal role in boosting overall transaction value. This trend highlights the increasing importance of securitization as a financing tool in the Italian private debt market. Diverse market dynamics. While the aggregate data paints a picture of robust growth, a closer look reveals nuanced differences across various segments of the private debt market. Direct lending, for instance, experienced a decline in value compared to the previous year, while other segments, such as mezzanine financing, showed signs of expansion. Investor appetite remains strong. The Italian private debt market continues to attract a diverse range of investors, including institutional investors, private equity firms, and specialized debt funds. This sustained investor interest underscores the perceived attractiveness of private debt as an asset class, offering the potential for attractive risk-adjusted returns in a low-yield environment. Outlook for 2024 and beyond. Looking ahead, the Italian private debt market is expected to maintain its upward trajectory in 2024 and beyond. Several factors are expected to contribute to this continued growth, including economic recovery. The ongoing economic recovery in Italy is expected to create new opportunities for private debt financing, particularly in sectors such as infrastructure, real estate, and renewable energy. Regulatory environment. A supportive regulatory environment with initiatives aimed at fostering the development of the private debt market is expected to further enhance investor confidence and attract additional capital to the sector. Investor demand. The continued search for yield by investors, coupled with the diversification benefits offered by private debt, is likely to sustain demand for this asset class. While the outlook for the Italian private debt market is positive, there are also challenges and considerations to keep in mind. Competition. The increasing popularity of private debt has led to heightened competition among lenders, potentially putting downward pressure on yields and requiring investors to be more selective in their investment choices. Risk management. As with any investment, private debt carries risks, including credit risk, liquidity risk, and operational risk. Investors need to carefully assess these risks and implement robust risk management strategies. Overall, the Italian private debt market is poised for continued growth and evolution in the coming years. As the market matures, it is expected to play an increasingly important role in the financing landscape, providing alternative sources of capital to businesses and contributing to economic development.
Thank you for listening to this episode of Hub Capital, the Investors Lounge podcast. I hope you found this content interesting and inspiring. If you enjoyed this episode, don't forget to subscribe to the podcast so you don't miss a single episode and share it with your friends and colleagues who might be interested. To learn more about T-Hub Capital and our activities, visit our website, hubcapital.com. You can also follow us on our LinkedIn page. See you soon. All the best from the T-Hub Capital team.